talked about the three critical investing concepts, and now that you have an understanding of the four main investment accounts, we're ready to jump into our last investing video and see how it all comes together. In this video, we're going to discuss investment options and the variety of investments that you can actually make and put into your shopping cart. After you have an investment account set up, what should you fill it with? What types of investments do you want to make? And what do you think will provide the best return according to your personal risk-reward preference? To simplify this topic, we're going to cover the four main asset classes that people invest in: equities or stocks, fixed income or bonds, real estate, and cash. Equities are the first asset class we'll cover. When you invest in equity securities, you're buying stock in a company. What that means is that you're buying an ownership percentage in the company, however small that might be. If the company performs well, then your investment will perform well. If, on the other hand, the company performs poorly, then so will your investment. With equity investments, there are two primary ways to see a return on that investment. The first is through appreciation or growth in the stock price, which represents the value of the business. If you buy a company stock when it's priced at $100 and the business performs well, then the stock price will rise. You can then realize a return on that investment by later selling the stock at a higher price. The way that you buy and sell stock is through an exchange, like the New York Stock Exchange, which brings together interested buyers and sellers to facilitate the transaction. Practically speaking, when you own equity through an investment account, you're able to go to the account provider, let's use Vanguard as an example, and sell stock that you own in your investment account directly through their website. You can also buy stock in the same way. The process is amazingly simple, and I'll walk you through how to set up an account and actually execute those transactions at the end of this video. The second way to see a return on an equity investment is through a dividend. If a company performs well and has excess cash at the end of the year, it can elect to distribute some of that cash to its shareholders through what is called a dividend. When this is done, each shareholder will receive an amount of cash that's equal to the distribution that has been declared by the company, multiplied by the number of shares that that individual owns. Now, as I briefly highlighted before, there are two primary ways to own equity. First, you could own shares in an individual company. For example, you could log into your retirement or brokerage account online and buy shares of Apple or Amazon or any other publicly traded company. And since we now know the benefits of diversification and how it can reduce the portfolio risk of our investments, if you wanted to build your own diversified portfolio, you'd most certainly want to purchase shares in more than one individual company. The other way to own stock is to purchase shares in a fund that is already invested in equity. For example, an index fund or an exchange-traded fund, commonly known as an ETF, that's based on the S&P 500. The S&P 500 is a broad market index fund that tracks and measures the stock performance of 500 of the largest companies whose stock is traded in the United States. This is a well-diversified index, so rather than buying individual stocks and building your own diversified portfolio, which can take significant time, capital, and be difficult to do, it's much easier to simply buy shares in a fund that's already done the heavy lifting of building a diversified portfolio for you. Now, there are literally hundreds of funds out there that will target equity investments tied to just about any industry or purpose or geography that's imaginable. Don't let this confuse you. My advice as you get started is to keep things simple. Start out by investing in a broad market index fund like the S&P 500. That will provide you the benefits of diversification and will make it easy and simple to get started. In fact, to this day, a broad market S&P 500 index fund is one of my primary investments. This is because it's simple, it's well diversified, and very easy to execute. Okay, now that we've talked about equity investments, let's move on to fixed income or bonds. A bond is a financial instrument that is essentially a loan made by an investor to a borrower. The investor will lend the borrower money in exchange for interest payments made at designated periods of time over the life of the bond. At the end of the life of the bond, known as the maturity of the bond, the borrower will make a final interest payment and will also return the principal amount of the bond, or the amount that was originally borrowed. Most bonds, they're issued by either governments or businesses. Bonds issued by governments are typically referred to as municipal bonds, while bonds issued by businesses or companies are typically referred to as corporate bonds. So why does a government or a business issue bonds? Well, because they need to raise money for a variety of purposes. For example, a local government might issue bonds to raise money so they can build a new school. Or a company might issue bonds so they can purchase equipment that will be used to manufacture the goods that they will sell. Why would any investor want to lend money to businesses or governments? Well, because they can earn a higher return or receive more interest than they would otherwise receive by holding onto cash. Because bonds or debt financing is so common, there are rating agencies that give governments and businesses grades or ratings on their credit worthiness. This enables investors to gauge the level of risk that they're taking on by lending an institution money, which, by the way, is very similar to how individuals like you and me have a credit score that banks will look at and analyze before they'll lend you money. The lower an organization's credit rating is, the more risky an investment is deemed to be. This essentially means that the organization will have to pay a higher interest rate on their bond in order to attract investors. The opposite is also true. An organization with a higher credit rating will be able to pay a lower interest rate on their bond and still be able to attract investors. In contrast to equity, bondholders are not directly rewarded according to the performance of the business. Rather, bondholders are only entitled to receive the stated interest rate on the bond in return for their investment. Because bonds are debt, in the event that a bond issuer were to go bankrupt, the bondholders would be compensated before the owners of the business. Or in other words, bondholders have a higher priority than equity holders. As a result of these nuances, bonds are generally understood to be less risky than equity. Similar to equity instruments, there are thousands upon thousands of bonds that you could invest in. And there are also hundreds of funds that represent a diversified pool of bonds that you could invest in. Each of these will be available for you to access through your investment account provider. The key takeaways here are, first, to understand that when you're investing in bonds, you are essentially loaning money to an organization in return for an agreed upon interest rate. And second, that bonds tend to be less risky than equities, and as a result, they generally provide a lower return. The third asset class we'll cover is real estate. Real estate is often thought of as a desired investment because of its appreciation potential, along with its ability to generate cash through rental income. It also tends to be a relatively safe investment, at least in the long run. But accessing real estate as an investment can be a little more challenging. One way to add this to your investment portfolio is to go out and acquire a property, a commercial building, a multifamily complex, a plot of land, or even a second home. But buying physical real estate takes a lot more time and money. It's not something that you can easily dip your toe into. You have to find the property, do diligence on the property, and then figure out how to pay for it or how to finance it. And if you're using a lot of debt, that leverage or debt will increase the riskiness of the investment. Because of these hurdles, far fewer people actually have real estate in their investment portfolios when you compare it to those individuals who own equities or bonds. But thankfully, there are other options out there. For example, there are special companies called real estate investment trusts, or REITs, that enable you to invest in a fund of properties that are owned and operated by the investors and managers of the fund. The REIT will pool money from investors. It will then buy and operate income-producing properties, which will provide a return to the REIT. The REIT then distributes those returns to the investors. Many of these funds are accessible directly through investment account providers. And while there are not quite as many real estate funds as there are equity and bond funds, there are still a lot out there to choose from. So if real estate is an asset class you want to invest in, don't let the natural hurdles that I explained before scare you out of making that investment. Instead, carefully study out the alternatives, speak to a trusted advisor or a good friend, and make a decision that's aligned with your goals and desired risk profile. The final asset class I'll cover is cash. Now, you might ask, is cash really an investment? And that's a fair question. But when you think about it, almost anything you do with your money outside of consumer spending could be viewed as an investment. An investment is simply somewhere you park your financial resources with the expectation that those resources will grow. So if you make the decision to hold your financial resources in a liquid bank account or an online savings account or a money market fund, you've essentially invested in cash. Now, there are pros and cons to investing in cash. The pros are that your investment is very safe, especially if you hold cash in an institution that is insured by the FDIC, or the Federal Deposit Insurance Corporation. Another pro is that your investment is very liquid. In other words, you can convert it into purchasing power for goods and services very easily. For example, when I hold cash in a checking account, I can spend that money at a grocery store. I can't exactly do that with my stocks, bonds, or real estate. This is exactly why it's smart to keep your 6-month emergency fund in a cash account, because it will be available to you whenever you need it. The main con or disadvantage of investing in cash is that it will provide a very low return. Given the current interest rate environment, if you were to hold all your investments in cash, it would take a very long time for those resources to grow, even with the power of compounding. This is precisely why after you have your 6-month emergency fund stashed away, you should begin investing in higher yielding assets like equities, bonds, and real estate. Well, there you have it. We've now covered the 4 main asset classes that people invest in. While there are plenty of additional nuances to each of these 4 asset classes, these fundamentals will create a strong foundation of understanding for you to build on as you get started investing. So let's recap what we've talked about in the past 2 videos, and then spend a few final minutes walking you through the steps you would follow to actually create your own investing account, and then to make your first investment. In video 8, we started off by talking about the different types of investment accounts. Remember that these investing accounts are like your shopping cart. They are the vehicle that hold your investments, and they each have unique characteristics. For example, tax benefits that are aimed at helping you achieve specific saving and investing goals. The first type of account we discussed is likely the most important, your retirement account. We spoke about 401ks, IRAs, and Roth IRAs. A 401k is an employer-sponsored account where you receive a tax deduction for any funds you contribute. Your employer is also able to make contributions to your retirement fund and will generally match your contributions up to a certain amount. So make sure that you're taking full advantage of that employer match. An IRA is very similar to a 401k, except that it's set up by an individual rather than an employer. It has very similar beneficial tax treatments, but the annual contribution limit is lower. A Roth IRA is also an individual retirement account, but the tax treatment is essentially the opposite of an IRA. With a Roth IRA, you make contributions with after-tax dollars, and you'll receive the tax benefit on the back end when you don't have to pay taxes on any withdrawals. Following our discussion on retirement accounts, we spoke about education accounts like 529 plans, and then health savings accounts or HSAs. Each of these provide a tax-efficient way to save for education and health expenses, respectively. The final investment account we spoke about was a brokerage account. This is an account that can be set up through a wide variety of banks and financial institutions, but does not come with the same types of tax benefits. As a result, most people will elect to start and contribute to their other tax advantage investment accounts first. After we established a firm understanding of these investment accounts, or our investment shopping cart, we spoke about the 4 primary asset classes that people most commonly invest in: equities, bonds, real estate, and cash. These are the actual investments that people make and hold in their investment accounts. And while there are nearly limitless investment alternatives out there, including individual bonds, stocks, physical real estate, and a host of funds, it's usually a good idea to start simple and not overcomplicate things. Some of my favorite investment options are broad market index funds and ETFs that make it easy to invest in a diversified pool of assets. So are you feeling ready to start investing? Trust me, once you take that first step, you'll realize that it's actually a lot more simple than you may have originally thought. So let me walk you through what that process could look like. To start investing, you'll first need to open an investing account. As I explained before, there are a lot of great companies out there that you can open an account with. And if your employer offers a 401k, then you could simply use that account that's already been created for you. For this example, I'll use Vanguard. If you were to open a new account, you could go to Vanguard's website and select Open an Account. Next, you'll walk through a handful of screens that will tell you the information you need and that will allow you to select the type of account you want to open. You'll then enter your personal information and complete the account creation process. Once the account has been opened, you can connect your normal bank account to your investment account, which will give you the ability to make investments using your cash. At this point, you're ready to invest. You can peruse and search all the various investment alternatives that are out there until you find what you're looking for. As you search for investments within Vanguard, or any other provider for that matter, you'll see lots of information available about the investment alternatives and funds. For example, you can see the current price, the historical performance, and the composition of the investment if you're looking at a fund. Once you've identified the investment that you want to make, you simply type in the amount of money you want to invest and click buy. It's that easy. It's also easy to set up regular, scheduled, programmatic investments, which, like we've talked about in the past few videos, will be the key to establishing consistency and paving the way to real wealth creation. Going forward, when you log into your account, a dashboard will show you your investment performance and any activity that has occurred. Wow, we have covered a lot of ground in the last few videos, and I hope you found it to be educational, helpful, and easy to follow as we've talked about the real nuts and bolts of investing. I also hope you feel empowered to begin your investing journey And if that journey has already begun, then I hope you feel better prepared and better armed to make wise investing decisions for yourself going forward. There's so much more that we could talk about, but these key concepts and fundamentals are the most important building blocks that will pave the way for your future success. So take this knowledge, start today, be consistent, and let your money start working for you.